Brad Williams, Frugal Finance. Synthetic callable debt? Consider a firm with an outstanding fixed rate obligation that possesses no call feature. The issuing firm would like to be able to call this deal in 3 years, but does not want the obligation to retire the issue. In essence, the firm wishes that the existing non-callable debt had a call provision allowing a call in 3 years. When a company calls a current debt instrument, it repays the debt. We may view this repayment as creating a new financing need that the firm will meet from floating rate obligations. After all, in calling the debt, it retired the existing fixed rate obligation. From this perspective, we may see that the decision to call an existing fixed rate obligation is like creating a synthetic floating rate debt obligation using a call. As we have just seen, a fixed rate debt obligation combined with an interest rate swap to receive fixed payments and pay floating transforms the fixed rate instrument into a floating rate obligation. However, in the present instance, the issuer wishes to have the option but not the obligation to make this transformation. Therefore, the firm can create a synthetic callable bond by using a swaption. Because the firm wants to possess the call option feature of a callable bond, we know that the firm must purchase a swaption, because only buying a swaption, an option on a swap, gives that flexibility. The swap that underlies the desired swaption must allow the firm to receive fixed pay floating. Therefore, the firm needs to purchase a receiver swaption with an expiration of 3 years. At the expiration of the swaption, the firm can simulate a callable bond by exercising its swaption. Upon exercise, the firm will continue to pay fixed on the existing bond, which is not callable, receive fixed on the swap, and pay floating on the swap. Netting out the fixed payment, fixed receipt, the firm is left with paying floating obligation, which is analogous to having been able to call the bond. Synthetic non-callable debt. A firm with outstanding callable debt can use interest rate swaps to eliminate the call feature and capture its value. When it issued the callable debt, the firm essentially purchased a call option from the bondholder. If the firm is sure that it will not wish to call the debt, it may wish to recapture the value represented by that call option. We consider this situation from the perspective of corporate financial management in our discussion of swaptions in section swaption. In essence, we now regard the example firm of the swaption discussion in swaption as having created synthetic non-callable debt by issuing swaptions. Table 22.1 shows how the firm maintains fixed rate non-callable debt whether or not the swaption is exercised. We have a call date scenario, we have a swap, we have the issuer, we have the result. Issue rate higher, swaption not exercised, does not call the bond, issuer has fixed rate financing. Interest rate lower, swaption exercise, issuer pays fixed and receives floating for the remainder of bond's life. Issuer calls the bond and funds with floating for a remainder term. Result, issuer has fixed rate financing. Synthetic dual currency debt. A dual currency bond has principal payments denominated in one country with coupon payments denominated in a second currency. For example, an issuing firm might borrow dollars and pay coupon payments on the instrument in euros. When the bond expires, the firm will repay its principal obligation in dollars. This dual currency bond can be synthesized from a regular single currency bond with all payments in dollars, a dollar pay bond, combined with a fixed for fixed currency swap. The upper timeline in 22.4 shows the cash flows from owning a typical dollar pay bond. The purchaser of the bond invests at the outset and then receives coupon inflows and the return of the principal upon maturity. The second timeline in figure 22.4 shows the cash flows for a fixed-for-fixed foreign currency swap in which the party receives the fixed euro inflows and pays fixed dollar amounts. Note, there is no exchange of borrowing in this swap. A currency swap with no exchange of borrowing is known as a currency annuity swap. Later in this section, we show how to price such a swap. The amounts of the cash flow in the currency swap are constructed to equal the coupon payments. Figure 22.5 shows the effect of combining the dollar pay bond with the foreign currency swap. The dollar coupon payments on the dollar pay bond and the dollar payment on the fixed-for-fixed currency swap perfectly offset each other. Euro inflows from the swap replace the coupon payments in this example. As figure 22.5 shows, the principal payment and repayment are in dollars. All of the coupon cash flows are in euros. Thus, dollar pay bond combined with the appropriate fixed-for-fixed currency swap with no exchange of borrowing produces a dual currency swap. Brad Williams, Frugal Finance. See you soon.